So hello guys, welcome again. Please go through the disclaimer that we are not providing any kind of paid tips or paid calls. So some fraud channels have been created on Telegram. So don't get cheated by them. So in this video we will talk about iFAAD version 2 strategy explanation video. So I hope you guys have already gone through the strategy document which Mr. Vishal have uploaded on the thread of this share code of iFAAD version 2, and basically this is it. Now up till adjustment 1 where we bring hedges at break even, this is same strategy as iFAAD version 1. So I would suggest you guys that you go through this iFAAD version 1 the strategy and code explanation videos, so that we can save this time in this video, right? Because this is same as iFAAD version 1. So basically we are creating on expiry day the iron fly, where this is the logic that which kind of hedges we are buying, and basically short selling the ATM strikes only. But I have made it based on future strikes. You can make as per spot strike also, it's your choice, nothing wrong, right? Because in this document there is no mention of whether we should choose spot based strikes or future based strikes, right? And then on next day on 3 p.m. we bring hedges at break even. Now I have done one changes. I have made this at next day 2 p.m. we bring hedges at break even. Now what the issue is, so what the problem is, as you can see here, for last 2 or 3 months, as market is very volatile, as you all know, strategy performance is not so good. The main reason behind that is before we bring our hedges at break even on next day 3 p.m. a major move happens either on upside or downside, and that's why before we bring hedges closer, our loss would have been very big by that time, and after that we can't do anything once our loss is gone, right? So in iron fly we need to be very quick. So I have made one mode version where we bring our hedges at break even before the next day 3 p.m. or 2 p.m. right? So that share code also I have given, I guess you guys already know, right here. So you can keep this also on the deployment page to compare both the performances, and once it performs well or as per the logic, I'll upload video of that also, right? So now let's take example of this week's trades only, and try to understand the strategy better. So as we can see here, we have short sell legs of 39,900 call put. So let's add them, right? These both legs we have sold, and we have bought hedges at 38,900 put, 4900 call, and let's interchange call and put here. So here we will keep put, here we will put call, right? Now suppose for example after the next day our hedges have come on break even. Up until that time we won't do any adjustment like this 20% decay or 30% decay, we'll let them happen. So this is one drawback of this strategy, where if market don't remain range bound until we bring our hedges at break even, there is very higher chances of making loss in this strategy, right? So I'm working on that also. So but that's the point of another video, I guess. So here we are understanding this strategy first. Until we understand to make basic iron fly, we can't go to advanced one, right? And Tradetron have many limitations, as you guys know. So this is our iron fly, for example. Now on Friday on 3 p.m. right, first adjustment, we will bring hedges at break even. So suppose for example their break even are for example let's take 39,500, or we can bring them somewhat less closer, right? Like 39,300, and here on put side and here on call side, suppose it's break even at these levels are 40,400, right? So on Friday 3 p.m. we'll bring our hedges at break even. So this is our first adjustment as per this strategy, right? If you guys don't know what is break even and all that, so let me put one sample for you guys. Like let's make one iron fly at 39,900 and option strike, as we all know, 38,900 and 48,800. Okay, 49,900 all. 38,900 and 40,900. So let's make this iron fly here. So now, as you can see, it's showing of last expiry. Let me change the expiries also. So from here only, let me make it 6th April, and before that, let me reset. Okay, so this is the iron fly which we have created yesterday. This seems like they have changed the strike prices. It's no issue. So this is the break-even points here on Opstra or any other option charting platform. You can see these break-even points, right? So around this break-even, so these are the strikes which we will buy once we close the other hedges, right? So we will exit these hedges first, and after that we will buy on the put side 39,600 and 40,300 on Friday, on next day. So this is our first adjustment, right? So let's write that down for example purpose only. So first adjustment, we will bring them closer. Suppose, as we taken the example of 39,400 put, and here 40,400 call. Here our strike is 49,900, so it will be around 49,500, 40,500 call, right? Right. So this is first adjustment, and this is our iron fly. So these are the break-even strikes. After that, we need to monitor call and put prices, the legs which we have sold. So let's take an example that we have sold both at 100 premium each. So as soon as there is 20% drop of any of the call or put, like price becomes 80 of our sold leg, what we will do is, if put side price have dropped below 20%, we will close this first adjustment break-even strike, and we will bring hedges 200 points inside, right? So we will buy hedge of 39,600 strike. In same way, if our call side is dropping below 20% of our entry price, of our selling price, suppose here if price becomes 80, we will keep this put as it is, the put strike as it is, if only call is dropping below 20%, and we will bring the hedge which is at break even after first adjustment hour to 200 points inside. So inside means we will bring hedges towards the sell leg strikes, right? So input we will have to add in the strike price, like here if we are having 39,400 put, so we'll add 200 in that. So we will buy 39,600 strike as hedge, and we will exit the 39,400. In same way, if we want to bring hedge of call inside, that means we will have to minus some amount from this strike price, right? So we will have to do minus 200 of this 40,500, which will bring us to 40,300 number. So we will buy 40,300 strike if call drops below 20%. So this is optional, like if call is dropping below 20%, we will bring hedge of that leg inside by 200 points, right? Now if again, so this is our second adjustment, right? So this is our second adjustment. Now again, if suppose call drops below 40% and price of suppose 100 rupee call becomes 60. Now as we have already bring our call side strike 200 points inside, we will again exit that second adjustment one, and we will again bring strike 100 points inside. So this is our final strike of call, which is 40,200, right? In same way here, if we have brought strike, if put have already declined 20% and then 40%, so put price have become 80 and then now 60. So after first adjustment our break even strike is this. After second adjustment, when put drop below 20%, our another strike will be 39,400 plus 200, which is 39,600 put, right? And we will keep on exiting the previous hedges. This is basic, right? And as soon as price drops below 40%, we will exit this strike also and we will buy 39,700 put, right? So these are the adjustments which you guys already know, I guess, if you have already gone through the this document. So this is basically that, nothing much complicated. You guys can do this manually also if you want. So these were the two adjustments basically. One is when we want to bring our hedges at break even. Another is whenever there is a decay in points, like a 20% decay or 40% decay in any individual call or put, then how we'll bring hedges inside, right? Now another adjustment is whenever any hedge become in the money by 300 points, right? So we'll simply book profit in that, and we'll shift our hedge strike for at ATM of that time, right? So suppose market was at 39,900 when we created this iron fly. Then on next day we have brought hedges inside on put side, for example, right? Now if market is going down, our hedge strike is this 39,400. So if market goes up to 39,100, that means our 39,400 put have become in the money by 3 strikes. We can say ITM 3, it have become ITM 3, it will be in profit. So we will book profit in this, exit this, and we will buy 39,100 put strike as hedge on put side, right? So this is the third adjustment. If any strike become in the money by 3 strikes, right? In same way, if our hedges is at 40,500 and market goes at suppose 40,800, so which means our call strike have become in the money by 3 strikes, right? So that is ITM 3. So we will exit this 40,500 call, we will book profit in that, and we will again buy 40,800, which is ATM at that time. So this is the third adjustment. I'll give you example in our already deployed this strategy so that you guys can understand this in better way. But let's first understand this, right? And it can happen that our second adjustment have also have happened, and we are already at 39,600 strike or 39,700 strike. So if this happens, and if market goes at around if strike is 39,600 and market goes around 39,300, then also this hedge have become ITM 3, and we will book profit in this, and we will again buy this 39,300. So in this way, any hedge which is active at present, if it becomes ITM 3, if I say simply, we will exit that, we will book profit in that hedge, and we will buy at the money strike as hedge on any side. This is actually very simple. And another is if market is in range of straddle 150 points on either side, and the straddle decays already more than 75%, then we will exit the short straddle, right? So we have sold both these legs if market remains in the range of 300 points from middle, right? So if market is between 39 minus 150 points, 39,900 minus 1, so 39,750, and between 39,750 and 40,050. So if market remains in between this range, and our call and put combined premium, whichever is, suppose we have sold both at 100, so our combined premium is 200, right? So if already it decays more than 75% decay is happening, which means both of this combined premium is at 50 or less than that, we will exit both these sold legs, right? And we will keep hedges until our universal exit satisfies, which is on expiry day 3 p.m. So we will basically exit the hedges and on expiry day 3 p.m. and we will close both the sold legs whenever 75% decay happens and market is in between this range, minus 150 points from this strike and plus 150 points from this strike. So between this 300 points range from middle. So that was the adjustment 4. And the fifth adjustment is nothing but exit everything whichever is remaining on expiry day at 3 p.m. and reactivate again at 3:15 for next week. So this will keep on executing week by week, right? So let's understand all these concepts using example of last week trades so that you guys can understand it better. So let me remove all this. Now this is current week's trades, and this is the last week trades, right, where it closed at around 7,140 profits. So let's understand this one by one. I guess we don't have data for previous week, unfortunately, so we will need to monitor these trades, this week's trades, and I'll keep on updating you guys on how this is adjusting. Let's talk the theoretically. Let me make that same here on Opstra. So we have got hedge of 40,900 at 48.85, two lots. So 40,900 at price of 48.85 we executed yesterday. 38,900 put we bought at 75.10. $39,900 call we sold at 390.20. And 39,900 put we sold at this price. I'm simply copying and pasting this. So this was the current status of this iron fly, which we created yesterday, because yesterday was expiry day. So max loss possible is this, max profit possible is this, probability profit of this. Now see here, as soon as market opens tomorrow, right, we will close both these hedges, but before that we will buy both these hedges because these are the break-even strikes, right? So we will buy 39,300 put and 40,500 call tomorrow at 2 p.m. and after we buy this we will exit both these hedges, right? Because otherwise margin penalty will occur, you guys already know. So we need to first buy and then exit previous. So that is the first adjustment as we talk here. On Friday or on next day, bring hedges at break even. Now another thing is, as you can see, our call price which we have sold of 39,900, call and put. So call we sold at around 390.20. so if we minus 20% from that, so if call price becomes 312 after we bring our hedges at break even, right? So if call price becomes 312 and we have already bought break even hedge of 40,500, then as 20% drop has happened, we will buy 40,300 call as strike, and then we will exit this 40,500, which was the break even strike of initial entry, our initial entry, right? Same way applies for put also, that if put drops below 20% of our entry price, then after break even our hedge put strike would be 39,300, right? So we will buy 39,500 put strike, add 200 points in this, and then we will exit this 39,300. These are the adjustments to watch for with our current iFAAD strategy code, this one, right? Because this is created yesterday only. So this was the first adjustment. Another is, whenever call or put drops below 40% of this initial entry price, whichever the hedge, right, like from 40,500 of call we would have bought 40,300 call, and then we will need to buy 40,200 call and then exit this, because this is bought at 20% adjustment, this is bought at 40% adjustment, right? So this is one thing. Another thing is, if by any chance, suppose we are at this break even hedge of 40,500 and market goes at 40,800, right? So then we will buy this 40,800 call, which is ATM at that time, and we will exit this 40,500 call in profit. So this is another adjustment. Same way on put also, if our put strike is at put hedge strike is at around 39,300, and if market goes below 39,000, then we will exit this. But before that, we will buy this 39,000 put, which would be at the money at that time, and we will book profit in this 39,300. So this is another example. So all these things I try to upload videos as our week progresses, so that you guys can have exact idea. But I am giving you overview of what adjustment will be done by this strategy. So what to look for in this shared code, right? And one last adjustment is, as you guys know, so these are our hedge strikes. So 300 points range, 150 point on each side from this 39,900. If market remains in this range and our profit of only short straddle, maximum profits 75% we achieve. Or in another way, I can say that if premiums drop by 75%, premiums decay by 75%, we will exit both these sold legs and we will keep only hedges open until next expiry, next Thursday 3 p.m. At 3 p.m. we will close everything, whichever profit or loss is there, right? So these are the broader overview and broader example of this ironfly iFAAD version 2. Now, when this will perform best and when its performance will not be proper. So as you can see here, losses are very big but profits are smaller. So this strategy, like every other strategies, have limitations of, suppose market moves 1 or 2% from current level before tomorrow 3 p.m. or tomorrow 2 p.m. where our break-even hedges will be bought. So before we buy our break-even hedges, if market moves drastically before any other side, upside or downside, then we would be in already half of this loss already, and then the adjustments will not be of any help and you will occur loss. So only limitation of this strategy is it should remain until tomorrow 3 p.m. or 2 p.m. under this range, if possible in this range only, like 400 to 500 points range of this from center point of our short straddle. So this is the limitation. If this happens, then this strategy will not perform better. If once our break-even hedges have bought, then the performance of the strategy is good. So I'm trying to make another modifications of the strategy of this ironfly, where we can bring hedges closer as soon as market start moving on any other side. But that will take time, I guess, due to some restrictions of Tradetron Strategy Builder. But if I am successful in making that, I'll also upload that also. One share code I've already given to you guys. This one, iFAAD version 2 mode test. So this is also under testing, and I have shared with you guys also on our Telegram channel. So only change in the strategy is we bring our hedges much earlier as soon as market moves, and we don't wait for tomorrow 2 p.m. or 3 p.m. So this is the only change I've made until now. I'm planning to introduce more and more changes in this basic version of ironfly. So let's hope for the best, because if I'm successful in making that strategies, that will be game changer for you guys, I hope. So yes, this is it guys. I hope you like this video, and I'll upload the code explanation also of so that you guys can understand better that how to make any kind of ironfly, right? So thank you guys, see you in next video.